finances, investing, estate and retirement planning? Well, I went to school so you don't have to. Welcome to Finances and Inherited IRAs. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through personal, tailored, and attentive financial coaching services. Together, we'll create a successful financial plan by examining your spending and saving habits, then guiding and educating you to your own personal success. Coaching services include evaluation of your spending plan, building your savings, financing your retirement, examining your insurance needs, and planning for your individual goals. Please contact me at capitalcoaching.net for an appointment and a free consultation. Today, a colleague asked me about an IRA that a family member had left to them. It made me realize that there are many differences between inheriting an IRA and opening one on your own. Additionally, the rules change depending on if the IRA is inherited from a spouse or not. So what is an IRA? It's an individualized retirement account. It's one where an individual can open a tax-advantaged retirement account that can be opened by anyone who has earned income through an employer. IRAs do require that you use them for retirement, or if you take out money before 59 and a half years old, you'll pay a 10% penalty for withdrawal. And if it's a traditional IRA, you'll owe income tax on what you take out as well, because it initially was invested tax-free. The only exception to this rule is the withdrawal penalty is waived if you use the money for educational expenses or a first-time home purchase. But be careful when considering these options, because if the account was meant for your retirement, then you will not have these funds for your retirement. And although you can take out loans for school and a home, you cannot take out a loan for your retirement. An inherited IRA is also called a beneficiary IRA, and it's one where you'll probably need to move the assets from the original IRA into a new one that you open in your own name. For those who inherit an IRA, you may not roll it over to an account you already have. You'll need to open a new account that you'll have to formally rename. Let's say the deceased is Luther Sneed and you're Martha Jones. The account must be renamed as Luther Sneed for the benefit of Martha Jones. Retirement accounts have something called required minimum distributions, also called RMDs, meaning that you're required by law to take out a percentage every year after you turn 72. This is because money put into these accounts has not yet been taxed, and the IRS wants to collect their taxes on it. These types of accounts include traditional IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, 457 plans, profit-sharing plans, and other defined contribution plans. It does not apply to Roth IRAs because those were funded with after-tax dollars. Roth IRA contributions, the money you put into the account versus the earnings made while the account grew, can be withdrawn tax-free as long as the account has been open for at least 5 years at the time the account holder died. Under 5 years, and you'll owe taxes on those earnings. Beneficiaries of inherited IRAs will not be able to add any additional money to an inherited account, and depending on when the original owner died, you may need to follow the required minimum distributions based on their life expectancy. Then, you may withdraw any amount at any time as long as the entire IRA amount is withdrawn by the end of 10 years. So you could leave the entire amount until the end of 10 years, December 31st, on their 10-year anniversary, but then you'll need to withdraw it all. And in any case, whatever amount you take out will be counted as income, and this could potentially be a large amount of money added to your taxable income. Or you could roll it into an inherited IRA in your name and take the RMDs over your lifetime. The potential benefit to this second option is that you can allow the IRA to continue to grow over your lifetime. Another consideration is whether the RMDs for the year of the death was taken out yet or not. This becomes a potential issue if the decedent dies near the end of the year and has not yet taken out their RMD by the 31st of December. If they've not, there's a 50% penalty for not taking out the required minimum distribution. This can mean that if the RMD is $10,000, you can be penalized $5,000 if not taken before the end of the year. But RMDs are just that. Minimum withdrawal amounts. You can always take out more, but you'll be taxed on any and all money taken out. Be sure and fill out the IRS's RMD forms to determine how much you must withdraw. You might want a professional to help you with this, as there is a lot to consider here when you visit the IRS website. However, the rules are different if you are the spouse of an inherited IRA. In this case, the IRS treats the IRA as if it had been your account all along. They call this assuming the IRA. You can make contributions and reset the RMDs based on your own life expectancy. To take ownership, you can either designate yourself as the owner of the existing account, roll it into an IRA account you already have, as long as you move a traditional into a traditional and a Roth into a Roth. Again, this is because they're already tax dollars or untaxed dollars. Or if you don't have an IRA, you can open a new one and roll it into that. Or you can also just cash it out as a lump sum. But of course, this has the potential for changing your taxable income for the year, so a professional would be a great asset in making this decision. Roth IRAs for spouses do not require any distributions because the IRA was set up with money that has already been taxed, so there's no need to take it out and have required minimum distributions. Rules are different for a minor child inheriting the account. They'll need to take RMDs based on their life expectancy, and then at age 18, in most states, they'll have just 10 years to withdraw the entire account, while a chronically ill or disabled child can stretch the distributions over their entire lifetime. IRAs are a terrific way to save for your retirement, but inheriting one has some special rules that you're going to want to check with a professional about to make sure that it doesn't affect you negatively. Thanks for listening to Finances and Inherited IRAs. I know you chose to listen, and I'm grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider. This way you'll get notified each time one of the podcasts drops. And share your favorite episode with a friend. I'd love you to leave a review because it brings financial education to others and helps me be found more easily. Also, be sure and let me know what questions you'd like answered, like Emily did, on any topics that you'd like covered by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember, I went to school, so you don't have to.